Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, June 3rd, 2021. As usual, I'll start out with a quick update on the broad markets. Some things certainly worth pointing out there today. And I want to kind of touch on a few different things. We're going to talk a little bit about AMC stock, what the Fed's doing, interest rates, so kind of just a whole potpourri of different things going on, and obviously things to watch, where it may affect your portfolio if you're a long-term investor, opportunities there, as well as short-term, trading opportunities for active traders. So we'll get into it all. It sounds like a lot, but it will not be a 45-minute video. That I promise. We'll keep it well under that. Starting out here with QQQ, what we have is a solid sell signal. Recent days have been waiting to see a breakout of this trading range, either to the upside or downside, favoring and expecting a downside break based on the technical posture. You had this divergent high recently put in, and it's simple stuff: wash, rinse, repeat. Divergent high, and of course then the sell signal, the breakdown, and that should lead to more downside here. Minimum, these same targets on the way up, they were bounce target zones. They were actually, most of these levels, including this 330 that was hit today, were targets on the way down before. Remember, this is just a kind of an extension, if you will, or continuation of the sell signal that we had triggered all the way back here in the beginning of May. So over about almost a month ago today, broke down, triggered a sell signal on the break of that 334 level right there, that yellow line, and kind of went around there, and we've come full circle. Not mentioned here. I don't know where the letters went. Sometimes maybe I didn't add it there, but I mentioned it. And both here and on the futures, we had a divergent low, which was a catalyst for this counter trend bounce so far, or the rally. You call it what you want. Maybe it's a rally to new highs. Only time will tell. Not what I'm favoring now, but divergent high, correction. Divergent low right here, rally. Divergent high. Wash, rinse, repeat. Simple stuff. We can go back as far as you want. This is, big part of my trading styles. Look for the divergent highs and then sell signals with trendline breaks. 5.5% drop, divergent high, 12% drop, divergent low, whatever that rally was into that divergent high, divergent low, divergent high. You get the point. Simple stuff. Again, there's nothing 100% effective in trading, but these are pretty good guides, if you will, to the zigs and zags in the market. And that's what swing trading is all about. Longer term investing, the same principles and tools apply, but you just have to apply them to the longer term charts. So this is a daily chart. You go out to the weekly charts, even more significant, and on that weekly, you've had divergences building up to this point. You had a little correction. The divergent high even got larger. The divergences continue to build. Should the NASDAQ 100 go on to make a marginal new high anytime soon, it is guaranteed to be just an extension of the divergences. So therefore, the longer term outlook isn't going to change unless we rallied quite a bit and then took out these divergences. All right, so let's talk about trading ops. Again, you see where the targets are. NQ traders, same thing. I was watching this blue line here. That's the recent trading range, and so futures traders would have had a jump start. The Q's gapped down because this move happened before the market opened today, and we gapped down right to that. That's where we opened the day on that first target there, 13,529 ish. That was a support level there, and now we're below it, which should open the door for the next drop down to this support zone here, about 13,383 to 13,350-ish, and then just back to QQQ real quick. That would be this level here, this target zone, about 327 down to about 324. So now I do have to say, and I've been saying it, the S&P 500 it still needs to see some of the key sectors break down. Although on the 60-minute time frame, we do have a breakdown. This was a divergent high, so I'm going to put a little DH here. That was our most recent divergent high. This is a very good support level right there. See, it's I don't know, let's round that number off. That I know you probably can't see it on the video. That's 418 right there. Why is that a good level? Well, we'll go back in recent weeks and even months here and look at all these reactions from below. Boom, boom, boom. These are just, what is that, 24 easily candlesticks. Popped it, tried to pop it, pop, couldn't hold it. And then once it became clear to the masses that that level would not hold, we went down. We came up again, finally a breakout in a big green candle. And that breakout proved to be a whipsaw. And this has been the story lately, guys. The broad market, I told you, has been chopping around sideways. It's frustrating for long-term investors or swing traders that aren't very active. I mean, if you're active, you can game these charts. The S&P 500 has been tough. The Nasdaq 100 has been easier to trade recently. And with the S&P 500, what it is, and I've been saying this, it's the financials and the industrials, a couple sectors just hanging on there that refuse to break down, but yet you have pressure in the tech stocks. That's why the Nasdaq 100 has been much weaker. And anyways, so that's what we're looking at here. But with all that being said, there's still a lot of reactions on this level here, and we gap down below it today. So let me make it very clear. Until and unless we make a solid recovery, what does that mean? Well, a big, solid 60-minute candle, especially a close back above that level. If we do, we still have, at this point, keep in mind, we're going to have gap resistance just overhead to contend with. Here's today's gap. There's yesterday's close right here. So that's the gap right there. And so all the way up to the top of the gap is resistance. So let me say this, that we don't have the breakdowns on the daily charts of the industrials and the financials yet. So therefore, it's hard to give an all clear sell signal on the market, even though tech has been weak. With that being said, if you want to take a shot at a short on the S&P 500 or even the Nasdaq 100, keep an eye on the S&P 500 as well. You can make a case for an objective short here, up to but not above the top of today's gap, because if they backfill the gap, that's to be expected or normal. But anything much more than that, that's going to be bullish. If they can recover that, because they would have recovered 418 after a brief dip below, and so that would be the latest whipsaw. All I'm trying to say is this is resistance right here from about where we are. We're just a hair above it now, 418.46 as I'm doing the video, which effectively is right on there. Remember, this is a 60-minute chart, so this candle's not finalized yet. If it makes a solid close above 418, like I said, that's near term, bullish, at least that by that one candle. And then you can also look at, besides the gap, you have these recent lows right there. That was comparable, or at least that was the most recent support level. A lot of reactions there. So there's your levels, and this yellow line, that's where we closed yesterday. So that's the top of today's gap. Today's gap would be from where we closed yesterday to where we opened today. Okay, so those are your levels to watch. Like I said, and of course we'll keep an eye on the industrials, financials. If and when we get sell signals there, I'll let you know. Let's talk real quick about fundamentals, and this is all technicals, and technicals by far are the much better guide, especially for active traders, swing traders. Fundamentals in the long run will play out, but in the near term there are quite often disconnects between a stock, the price of a stock or the stock market, and what the underlying fundamentals are, and that's where there's opportunities in trading and investing. And that's why ultimately, again, over time, if a company has very poor fundamentals like AMC, we're going to talk on in a minute, that stock will go down. It will probably go to zero at some point. So there's certainly an opportunity there. I'm going to get on that in just a second, but let me show you something else that's going on. Okay, this a couple months ago, back up, I put a post out, time for the Fed to start tapping the brakes. And at that point in time, there wasn't really much of a rumble about worry or concerns or buzz in the media about inflation. And now there most certainly is. And at that point in time, even after that, Chairman Powell was very adamant that he believed that the inflation was just transient, would pass, and it would just prove to be an aberration, and it was not a risk. And so anyway, I said, look, we're going to see them. Ultimately, he's going to have to eat crow, and the way it's going to happen, the Fed will have to reverse course and start to get a little more hawkish. They've been uber dovish, as the Fed has ever been in history, with some extremes keeping rates at zero, incredibly large bond purchases, quantitative easing. And so the way I said it would happen gradually. That I can tell you with almost 100% certainty, and I'll usually say fewer things. There are almost no certainties in trading and investing, but that's one of them. This Fed will not surprise the market. Fed of yesteryear, maybe, emergency rate cuts, unannounced, or rate hikes, things like that. This Fed won't do it. So I said the way it'll happen, you'll hear rumblings, and it'll start out with Fed officials, Fed members. They speak all the time at different venues, and you'll hear just talks, and that's what we've been hearing. And it's been an increasing, buzz about, maybe that, we're aware of the inflation, but and now we maybe need to be concerned if it's going to be something more than just transitory. So you're hearing that. At least I am in the headlines, and that's starting to increase. And then what they did recently, the Fed met in the Fed minutes. There was now talk about tapering the bond purchase program, the Treasury bond purchases, and so that's number one. That is a way. That is a soft, gradual taper, talking the market down to start to expect a reduction in the bond purchases. And then just yesterday, I believe it was, the Fed now announced they are going to start unwinding its corporate bond holdings. If you guys remember, back when COVID hit, the Fed stepped in. They invoked emergency charters to give them powers that they normally don't have, and that was to intervene in the corporate bond market and buy, in their portfolio, buy corporate bonds. Now, when COVID hit, the markets were plummeting, and caught an opportunity back here. We had a couple short trades on LQD before the masses realized it. I said there's going to be a huge drop in corporate bonds. We caught a short trade here. We shorted this breakdown right there, and right on time, perfect entry. And then the masses started to realize, okay, yep, what's going on in the stock market is going to affect the corporate bond market. And boom, we hit that final target right there, T3, got out, sidestepped a big bounce to get back, re-shorted. This was the second short entry, hit the first target, and we were on the way. I believe there was one more target, and boom, that's when the Fed stepped in and invoked emergency charters to allow them to intervene and pretty much stop that flow. So they stepped in and bought massive amounts of not just corporate bonds, for the first time in history, corporate bond ETFs like this one and others. And so that's been artificially propping up the corporate bond market. But now, again, where am I going? I'm not trying to ramble here. This all ties in fundamentally. The brake tapping that I talked about, tapping the brakes, on this uber easy money policy has begun. It is now underway. I'm seeing a clear trend. This is just the latest in it. They're talking about, tapering their bond purchases as well, unwinding the corporate bond holdings. What they said, you can Google it, read about it. They're going to start with the ETFs and selling off the ETFs that they bought, and then they're going to move to the individual corporate bonds and sell those. And they're going to do it, of course, as they should, in an gradually and orderly fashion, meaning they're not going to crash the market. It might be a tough short trade. If your thoughts right now are, well, Randy, why don't we short the LQD? That's been announced, and LQD is holding up, and so is FALN. That's another one that they most likely took a big chunk in. These are bonds that were previously distressed bonds. And I'm sure that was part of their they definitely supported that ETF either directly or indirectly. And now the thing is, they're not going to let it crash like this again. They will step in. They're already pot committed on this, so they're not going to just sell everything and let this happen. So is there an opportunity there? Well, this opportunity, I will say, and I've said this, I've been adamant on this for at least the last year, one of the single worst long-term investments, in my opinion, right now are bonds, period. And the question's been put to me here, and I've shared my thoughts many times. And we'll just look at TYX. This is the 30-year bond, and we go back to a long-term chart. You go to a monthly chart. I've talked about this. Interest rates have been in a very clear secular bear market. A secular bull or bear market is the larger trend when you step back and look many years or even decades. In other words, the stock market is in both a cyclical bull market and a secular bull market. I'm talking about the stock market. And these are bonds. So within the secular bear market of rates, and I should clarify, I think I just misspoke. Bonds themselves have been in a secular bull market. These are interest rates. Interest rates and bonds move directly opposite or inversely one another. And so falling interest rates since the early 80s define the secular bear market in rates, which has been a bull market in bonds, and they hit the floor. And it was a very orderly uh, uh, declining channel, and within that secular bear market in rates, you had these cyclical bull markets, rallies that lasted years. Remember, I'm going back decades here, so these rallies are years. And then what happened here? This was, the largest intervention of the natural process of supply and demand, the largest intervention in the financial markets in history, starting back in 2008 when the meltdown happened and the Fed started with quantitative easing and bond purchases and rate manipulations, and then several rounds of QE since. And then this is where they hit the nuclear button, that button that, metaphorically president hits and all the missiles start flying. That was the nuclear option right there. Took rates down to the floor. And so especially from that point, you had literally about 0% upside in bonds if you own bonds, and only almost guaranteed downside if you bought bonds at that point. When you buy bonds near zero rates, there's no more room for the rates to go down. Powell has said he is against taking rates to negative in the U.S. And even if he did, that's just pushing on a rubber band there, where there's only a little bit of downside. So here we are. We're back into the channel about where rates should be, and they could go down. We could have another leg down, but again, this is the long-term rates. When you go down to the shorter-term rates, this is the 10-year, same thing. There's our secular bear market. We're back about where this channel was, the natural channel before. Again, quantitative easing there, and we're back to the bottom of the channel. And history tells us when you get to the bottom of a price channel, your next move is usually the top of the channel. So I didn't draw that line out perfectly, but I think you guys get the drift. So that's it. So that's where we're at. And the takeaway is, you might say, well, Randy, you just spent 5 minutes talking about bonds. I'm here, I like to trade stocks, I like to invest in stocks, I'm not a big bond person. Well, make no mistake about it, this directly affects the long-term outlook for stocks, not the very near term. We can sharpen our pencil, and I'll do that in a second here, and get down to the shorter-term charts to try to figure out where rates go from here over the next few days to weeks to maybe months. This is years right here. But make no mistake about it, that drop in rates, I was going back to the early 80s, so let's put it right here. This is that secular bull market in the S&P 500. That's when rates peaked and started to drop, and there's been, just like there's been cyclical bear and cyclical bull markets within this larger secular bull that we're in. And then this is, of course, you can see on here, the primary bull market uptrend line for the secular bull market. And like all uptrend lines, those eventually get revisited. You come back and you check that trend line. Last time we checked it was back there in 2008. And, at some point in the future, whether it's over the next year or several years from now, we'll most likely come back and visit that longer term trend line. Okay, I'm going to get off the markets, but before I do, I'm just looping back because I'm noticing on some other monitors a bounce, and just wanted to mention that this bounce is going to take us back to that 332 level. That says 331.96. We're going to call that 332, which was the bottom, and that also provides an objective short entry. So I gave you the levels earlier on the SPY on the shorter term charts, showing you where an objective short would be and where it's no longer objective. Same thing here. Ideally, this is where the seller should step in. That would be a back test of the bottom of that recent trading range and provide an objective short entry. So especially for you, if you don't trade futures, or even if you do and you weren't up at 5:30 in the morning or whenever that support level broke down, and so you woke up to the gap down in QQQ, well, and you missed that because you didn't want to short, nor would I, on a gap down that half the move is already played out to the next target. This provides another objective entry right here, with of course a stop somewhat above. Somewhat can be tight. You want to just keep a very tight stop, or above the top of the recent trading range, really that spike high, that reaction high around 336 right there. And so you look at it this way from a risk reward perspective. So if you're going to use a stop of 336 and you short here, that's going to be a 1.3% loss, or let's say a little bit above that, call it 1.5%. So therefore, make it worthwhile. If you think we're coming back down here, which I think is a good shot, that those recent lows there about 316.17, that would be about a 4.6% drop. So that's an attractive risk reward. Risking 1.5% to make almost 5% there. And if that happens, there's certainly the potential for much more. Especially if we take out that recent double bottom low, these two lows right there, about 316.17. So that would open the door, I believe, to actually at least a run at this low from back in early March, and that's quite a bit more. Alrighty, quite a bit there, but again, I talked about the stock market both from a technical and a fundamental perspective. And the fundamentals, again, are starting to everything that I figured would be happening is happening, and it's happening gradually, as I said. That's why we're not cratering. That's why the financials haven't broken down yet, because right now it's just early buzz, early talk about the Fed starting to taper. Anyway, let's now look at the US dollar. That's also holding support. Been mentioned in the support zone, with the bottom of which about 89.65 or so. And so far so good. We've had multiple tests of that level, starting to move up. Took out the trend line recently, the primary trend line right there, back tested it, and now we're coming right up on this previous reaction high right here. So essentially we need to take that out. We're starting to crack above it, and I think we will. And I still maintain the minimum target there of 90.83 and a preferred bounce target zone. This is where I think we'll be headed most likely at minimum, maybe more than that. That last divergent low, we certainly had more than that. And so that if we get this, that should continue to put pressure on gold and silver in the near term. And I gave you those charts today. This is what happened to gold. Because of that, we're finally seeing, up here, some traders don't even know the correlation between gold and the dollar. Most do, and then up here, I guess they were just dismissive of it, wanted to see which way it would break, thought the dollar might break down. So gold was holding up. And I guess, on that flip side, the dollar really wasn't going up either. It didn't go down. So it's not mere coincidence. They've both been trading around here. And, I look at it as a sort of like a, it's a battle, if you will, between bulls and bears. So if the dollar bulls win this battle, then the gold bulls, and I think they're going to, at least in the near term, again, I think that's what the odds favor. Then the gold bulls lose, which at this point, it looks like they've started to lose this battle right here. And again, it's the technicals. It's not just a wild guess. You have the negative divergences on gold, positive divergences on the dollar, and then gold broke support when the dollar broke out, started moving up today. That's not mere coincidence. And then boom, this is the most impulsive drop we've seen in gold since right here. So far so good. Down below that 1876 support level, with the trend line still a very likely target, and also a minimum target, I think, to hit that trend line, and quite possibly pull back a little deeper here at about 1848 and then 1800. And that's a really nice support level. If we get there, especially if the charts confirm, maybe even if we get here, I might be interested in getting back into gold and and silver and GDX, those type of things. But for the near term, it looks like we're probably going to see more downside, especially with today's pretty much sell signals on gold. Remember what I said this morning is, from a micro perspective, we had a minor trend line here, which we broke down and just recently back tested, and that came on the heels of that divergent high. So that was the technical catalyst for this move. Silver, if you trade silver, I don't have to tell you this. It tends to move in the direction of gold, but just up more or down more. It has a, it's a more higher beta to gold than gold itself, as are the gold mining stocks. So here's what happened to silver. A few brief, these weren't even sell signals. They were intra-period dips below the trend line there, recovered each time. This was a breakdown. It wasn't very impulsive. We back tested, failed to regain the trend line, and then boom, an impulsive drop. And again, this is the most impulsive drop right here in silver, one of the most impulsive drops, at least in months. And so that helps to validate the this right here, the impulsive move, in my opinion, helps to give you a little checkbox to validate a sell signal, the fact that it was impulsive after the back test. And again, that should open the door to at least that 2680 target. And if things get a little ugly and that gets taken out, that is support, then your next support level and target's about 2580, we'll call it. And of course, since gold's down today, GDX is down 3%, 3.14. And you can see also it gapped below. We had a recent consolidation area there, and this is the way it broke, and it's an impulsive breakdown. So, that would expect us to, come on down and probably see more downside in the coming days here in GDX as well. Finally, to wrap the video up, let me talk a little bit about AMC. I mean, this whole, the stock market's always fascinated me. That's where my passion has been. And this is an interesting case study here. I think we'll look back on this one. I mean, they're calling AMC one of the meme stocks, AMC, and now, I mentioned BlackBerry as being on the radar of this group. Showed you BlackBerry the other day, actually a month ago, and posted that as an objective long entry here. And the memes, the meme Reddit traders, if you will, have pumped this one up. GameStop was their first one. You guys have all heard about GameStop, unless you've been living in a bubble. They engineered this short squeeze, and so they think, basically, I can tell you this because I have inside knowledge of this. I know at least several people, friends of mine, that are on that side of it. They're immersed in these Reddit groups, and they believe emphatically, and again, this is why I wanted to talk about it. It's amazing that that they're going to be able to engineer even a lot more upside back on AMC. So let's talk on AMC now. We already know what happened, and look, so far an impressive run. Just in the last, let's just pick a point here. Let's just talk about this point right here. The stock has rallied a 535% in a matter of not even 2 weeks right there. So so basically, let me tell you what the buzz is. They are emboldened, as one might think, and I speak it's again collectively. These are people that tend to, and I'm generalizing here, and I understand that that's can be a dangerous thing, but I'm generalizing. Most of these are inexperienced traders. Some of them don't even know the difference of a stock and a bond. Don't have much, if any, experience in trading, and they were, they got a taste of it there on AMC, and if they didn't, the first run up when they first pumped it, and as well as GameStop, and they did it again. So here's where I'm going, and I'm getting a lot of feedback on this. They are absolutely emphatic that this stock is going to go to anywhere from the numbers I'm hearing are at least 100 to 200, somewhere in that 200 250 range, maybe even 1,000. They believe that's they're going to engineer the mother of all short squeezes, something to even exceed what happened in GameStop. Of course, look, I don't think this can go that high. I do know that they took down. We know that the two hedge funds pretty much collapsed from the GameStop incident. But these are Wall Street. You've got the smartest people out there professionally, and yeah, okay, the Reddit group outsmarted them the last time, especially in GameStop here. But I want to believe that hedge funds that was a tongue twister for me, are not going to make the same mistake twice, and they actually do have a pretty good short interest. But I would imagine that they've also protected their downside and maybe haven't bit off more than any one fund can chew, and they're going to ride this thing out. That's what I'm hearing. That's what I'm reading. That the hedge funds are still short AMC, and now here's what I want to talk about a little bit. First of all, if everyone thinks something's going to 100, you're going to have traders step in early. And what I was trying to explain to some of these folks that I know that are in this on the long side is that stocks, and they're making the same argument, stocks go up when demand exceeds supply. So this crowd have pretty much banded together. They call themselves the apes. They post these little memes, a Planet of the Apes, where the apes band together and beat the humans. And so they think they're going to beat the Wall Street, and maybe so. We'll see. At this point, they certainly have. I mean, if you bought here, you're still way up. However, again, this is a vast consensus. You can read all about this. Go pull this article. Go to investing.com. Google this share sales takes puff out of AMC price, and then go to the comments section, read the comments, and you will see what I'm saying. They are emphatic that this is just lies by the powers that be, hedge funds, and they control the media, apes stronger together, and you'll read it over and over and over. These guys are emphatic. They're going to hold. And that's their mantra here is hold the line, keep buying. Well, look, sooner or later that buying dries up. Smart money is not touching the stock on the long side right now. What's exacerbating the move, obviously, is high frequency trading. But the technicals will ultimately prevail. So let me show you charts that I posted yesterday. I sent to one of my friends interested in this stock. This actually was long. Okay, so this is a 1 minute chart. That's really mostly all you can go off right now with this parabolic run in AMC. And so we were here yesterday about $65 and a sell signal to come. Here's what I gave him. Sell signal to come on a break below this uptrend line. Price target shown at line breaks. That's about 49.50, 36.61, and then 32.71. These are what I call HPT, high probability targets. And I think we'll get at least that 36.61, and ultimately, we'll go on and hit. The stock is worth pretty much zero. I mean, that's what's at least one analyst is saying based on the amount of debt they have. There's a little more I want to talk about. That's why I'm focused on this one right now. So that was yesterday. There's the purple uptrend line again, 1 minute chart. Let's just zero in today. Here's that trend line, same trend line, and there was a breakdown. Came a little after I shared that chart. Went on to make a perfect back test of the same trend line. That comes off the lows right here just from day before yesterday right there. There's yesterday's trading. That's where we gapped up. There's where we closed. Breakdown back test. Hit that first target, 49.50. Had a little bounce. These are trading halts, by the way, when you see these little sideways arrows, sideways lines. There's a trading halt, trading halt, trading halt, trading halt. Had a kickback rally, halted today. I actually sent this to someone, said, look, we'll probably get a snapback when we're halted here, and then it should be contained by 60.43. That was pretty big support right there, and so we're headed down now to that first target, and again, my minimum preferred target of 36.61. Where do we go longer term? I think down, I give you this target on the last, we had a short here that didn't work out on a short at 20. Down there to at least $9. And again, ultimately the stock is probably worth zero. But now a couple things I want to talk about in addition to that is this. Okay, AMC, they filed to sell 11 million shares. The stock was down earlier today in pre-market, then went positive after the open, but they filed to sell 11.5 million shares. Stock went negative in pre-market, giving up a big gain. They said they plan to use the money from the stock sales for general corporate purposes, which may include paying down debt, acquiring theater assets, and they came out and stated this. We believe the recent volatility in our current market price reflect marking and trading dynamics unrelated to our underlying business or macro or industry fundamentals, and we do not know how long these dynamics will last. They go on to say, let me see if I had it here, that they warn shareholders Here it is. Under the circumstances, we caution you against investing in our Class A common stock unless you are prepared to incur the risk of losing all or a substantial portion of your investment, AMC said, echoing a warning from regulators earlier this year on the potential pitfalls of such stocks. So here they are, warning people that they may lose all their money, that they're saying the share price is unreasonably valued. We all know that, and so do the Reddit group, by the way. They're trying to maintain the consensus is they know the valuation isn't there. They can keep buying, and engineer this massive short squeeze. Now, where I'm going with this is just yesterday, the CEO came out and said, guess what? Anybody that buys even one share of stock, he gave this popcorn pledge. So you can get free popcorn if you're an AMC shareholder. Okay, I've been in the business long enough to know I believe that there's a good chance they're going to come after this company now and the CEO for stock price manipulation. On one hand, they're saying the stock's overvalued, but they love this run up because now they're going to sell their shares. The company is going to sell some of their Treasury shares that they hold at these inflated prices, and so they're coming out and pumping this. Now, who does that play into? Let's talk about what demographic is going to hear about that and go out and buy 1 share, 5 shares of AMC on Robinhood. Is it going to be your hedge funds? No, those guys, even if they wanted a free tub of popcorn, they're probably not the demographic that goes to a theater and eats a butter-soaked tub of popcorn. But point being, that is a direct, to me, a solicitation or encouragement to get these Reddit-type people, that crowd, the retail investors, the demographics that go to a movie theater and buy a tub of popcorn to come in and continue to pump this stock up. That's what I'm reading. You can interpret any way you want. So this could be the beginning, the end for this pump right here in AMC. And I think the regulators probably come after them for doing that. Again, that's fundamental ramblings, but that's part of what I do. Most of the time I'm talking about charts. And the charts, of course, are the guide. If you're trading AMC, these are, again, targets and things to watch for. And the other thing about this run is turn off all the lines. The one thing over the years I've seen many securities do a parabolic run. That's a parabolic curve like that. There's your top right there. When any security goes in a parabolic spike, almost always, with very few exceptions, I can't even recall any offhand, you have a near vertical drop from the peak right there. Once that parabolic run ended, there was a little kickback rally along the way, but the stock fell 75%. So after parabolic runs, you usually don't see this consolidation for months and then another leg up or a gradual drop down. You usually see that run drop, the stock fall just as fast as it rose, or nearly as fast as the lead up to it. There's GameStop. There's your parabolic run, right? You went completely parabolic right here, and from the top right there, the drop was 92%. Meaning, if you were the person, the unlucky soul that bought right there at $100 or $488, you lost almost everything you had at that point that you put in. Now they came, it's still a meme stock, so they jumped back in, they bought it, but it's still below that high there. And again, I don't have any, GameStop. Longer term, fundamentals say it is going a lot lower. This is probably the trend line I'd use now. And my point wasn't to talk about GameStop, other than to just show you what happens after parabolic advances. And that's probably what's going to happen here in AMC. Look, don't trade the stock if you don't know what you're doing. Maybe they are able to engineer a squeeze up to 100, 200. Who knows? There are no guarantees, but I doubt it. Again, it's going to be when the last of the Reddit folks run out of gas. When their buying overwhelms the selling of both hedge funds, which are holding tight on shorts and probably adding to shorts. And keep in mind, AMC just filed to sell 11 million shares. So they're a guaranteed seller. And I'll tell you what, if they don't sell at these high prices, they'd be a fool. And they're probably going to, face shareholder lawsuits there. Like I said, it's lose-lose for the company. There's no way this price is sustainable. It's just a matter of, is that it? Was yesterday the end of the run, or is there another leg up? But this stock is coming down. It's going to come down very far, and there's another potential trend line that comes into play right there. Enough on that. The video is going to be almost as long as I said it wouldn't be, but we're going to stop it here at the 39-minute mark. Anyway, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.